Hi, there's a lot of talk lately about gold falling, silver stocks bleeding, and mining investors wondering if the whole move is already over. So in this video, we're going to separate panic from probability, and you are going to walk away feeling a lot clearer, a lot calmer, and hopefully a lot smarter about what is actually happening. Today is Monday, April 27th, New York time. Comment below what day and date you're watching from, because this market is moving fast and the context matters. And before we get into it, if you value this kind of work, subscribe and comment John A.G. Best. Short and simple. That tells me you want more breakdowns where we take messy financial noise and turn it into something useful. So, in case you haven't been following the mining space closely, the last several weeks have been uncomfortable. Gold is still historically expensive, but it has not been acting like a straight line rocket. Silver equities have been hit even harder. Junior miners have been tossed around like small boats in choppy water. And at the same time, energy prices, inflation worries, Fed uncertainty, and critical mineral supply chains are all pressing on the same nerve. Now, on the surface, the story sounds obvious. War risk rises, gold should rise. Oil rises, inflation rises, gold should rise. Right? Well, not always. And this is where a lot of investors get trapped. They take the headline and assume the asset has to obey it immediately. But markets do not work like that. Sometimes the first reaction to stress is not buying. Sometimes it is liquidation. Let me show you what I mean. If a leveraged investor is losing money in one part of the portfolio, they may have to sell another part of the portfolio just to raise cash. They do not always sell what is weak. They sell what they can sell. Gold is liquid. Larger miners are liquid. Even some small mining names can be dumped quickly when someone needs cash. So you can have a bullish, long-term gold setup and still get short-term selling pressure. That sounds contradictory, but it happens all the time. Think of open positions like a bathtub. Water's flowing in, water's flowing out, and if you only look at the water level for 1 second, you might think nothing is happening. But underneath that surface, a lot of movement is taking place. That is how this mining sell-off feels. The metal price is one thing. The shareholder base is another thing. Forced selling is another thing. And if you confuse all three, you end up making emotional decisions. So the first question is not, why is my stock down? The better question is, what changed? Did the project get worse? Did the company lose access to capital? Did permitting become harder? Did management miss a deadline? Or did the stock simply get dragged into a market-wide unwind? Because those are very different problems. A broken thesis and a broken chart are not always the same thing. Now, gold itself is still in a very unusual position. Based on recent market updates, spot gold has been moving around the high 4,000 range, near levels that would have sounded ridiculous not long ago. And recent gold research has also been talking about unusually high gold volatility this year, which fits what investors are feeling on the screen. So yes, the pullback hurts, but this is not gold trading like a dead asset. This is gold digesting a violent move while the market tries to price war, oil, inflation, central banks, and the dollar at the same time. And this is the important part. Higher oil can help gold if investors see it as a crisis signal, but higher oil can hurt gold if investors think it keeps the Fed tight for longer. That is the tug of war. One side says fear, the other side says rates, one side says safety, the other side says no yield. And that is why the price action can feel so frustrating. The inflation data helps explain why. Based on recently published U.S. inflation numbers, energy jumped sharply in March, and gasoline did most of the damage. That matters because energy is not just one line item on a report. Energy touches freight, food, mining, manufacturing, travel, and consumer psychology. When gasoline jumps, people feel it immediately. When diesel rises, companies feel it inside their cost structure. That is why producers and explorers should not be treated as the same thing. A producing miner has real operating costs: diesel, power, labor, maintenance, transport, insurance, everything. If metals prices rise faster than costs, margins expand. Great. But if oil keeps rising while gold and silver stall, margin pressure can show up very quickly. Small exploration companies, on the other hand, usually do not have the same diesel exposure. Their risk is different. Their risk is financing. And financing is the heartbeat of junior mining. A junior with a beautiful project and no cash is still a problem. A junior with a mediocre project and aggressive promotion is also a problem. A junior with a strong asset, credible management, realistic catalysts, and enough money to reach the next milestone, that is where the work begins. Not where the work ends, where it begins. So when people say some mining stocks are down sharply from their recent highs, my response is, okay, but why? If there was no bad company news, no broken permit, no failed study, no collapsed metal price, and no ugly financing, then maybe the move is liquidity. But if the company quietly needs money, or if the market no longer believes the timeline, then the sell-off may be warning you. This is why you have to fact-check your own holdings, not just once, repeatedly. Pull up the latest filings. Look at cash. Look at burn rate. Look at warrants. Look at debt. Look at the next catalyst. Look at who owns the stock. And then ask the simple question, would I buy this today if I did not already own it? That question is brutal, but it is useful. Now let's talk about the Fed for a minute, because this is where the gold story gets more complicated. The latest policy statement still emphasized inflation, employment, and elevated uncertainty around the economic outlook. It also pointed to uncertainty from Middle East developments. In plain English, that means policymakers are not operating in a clean environment. They have inflation pressure from energy on one side and potential growth damage on the other. So if somebody tells you the Fed will obviously cut because markets are nervous, be careful. If somebody tells you the Fed will obviously hike because gasoline jumped, also be careful. The Fed is watching both sides, and that is why gold can chop around. The market is trying to guess which problem the Fed will fear more. Consumer data adds another wrinkle. Some confidence readings have looked weak, and short-term inflation expectations have moved higher. That is not a comfortable mix. It means households may feel worse at the same time they expect prices to keep rising. And when households feel squeezed, they change behavior. They pull back, they sell risk, they delay purchases, they become less patient with volatility. That does not mean the entire stock market has to collapse tomorrow. It means the surface can look calm while stress builds underneath. Big indexes can hold up because a few giant stocks carry weight. But small caps, juniors, developers, explorers, and speculative stories can already be in their own recession. And that brings us back to silver and gold equities. The silver names being discussed in this cycle mostly fall into three buckets: producers or near producers trying to benefit from higher silver prices, developers with studies, land positions, and permitting angles, and explorers with resource upside but limited margin for error. Each bucket needs a different lens. For producers, you watch margins. For developers, you watch capital cost and permitting. For explorers, you watch cash, drilling, and dilution. Do not mix those up. A producer with rising costs is not the same as an explorer waiting for drill results. A developer on private land is not the same as a project stuck in endless permitting. And a company with a new study is not automatically cheap just because the study headline looks good. This is where investors sometimes get lazy. They hear Nevada, Mexico, silver, private land, new management, or strategic partner, and they assume those words equal upside. They might. But they are clues, not conclusions. If you're successful, share your success story in the comments so others can stay motivated. And while you're there, tell me this. Right now, would you rather own a cash-flowing producer or a beaten-down junior with bigger upside but more risk? Now, energy deserves its own section because it is quietly driving a lot of this conversation. The latest short-term energy outlook expects Brent crude to remain elevated into the second quarter before easing later, and recent oil market updates have pointed to tight supply and geopolitical risk. That matters for miners. A gold mine cannot ignore fuel. A silver mine cannot pretend diesel is free. If refined product markets stay tight, operating cost assumptions can become stale fast. This is also why energy juniors and helium names have entered the conversation. Investors are looking for ways to benefit from the same stress that is hurting mining costs. Oil exposure is obvious. Helium is more specialized. USGS data shows helium supply is concentrated among a small group of producing countries, and recent disruptions have made the market more sensitive. But here again, scarcity alone is not enough. A helium junior still has to execute, process, transport, and sell into real contracts. So when you hear that a helium company could be in production soon, treat that as a catalyst, not a guarantee. Production is where the story starts to become testable. Before that, it is mostly promise. And that brings us to the defense metals angle, especially tungsten. This is probably the most important theme in the entire discussion. Tungsten is not just a random metal with a nice chart. It is used in hard metals, cutting tools, aerospace, defense applications, and other high-stress uses where substitution is not always easy. USGS material shows China is the dominant global tungsten player, and U.S. critical mineral policy has been moving toward supply security and domestic production. That means Western tungsten projects may get more attention than they did in a calmer world. But let's not get carried away. Strategic metal does not mean guaranteed winner. It means the market has a reason to look. After that, the company still has to prove grade, scale, metallurgy, permitting, financing, and timeline. This is where some investors make a big mistake. They hear critical minerals and assume every small company in the space is suddenly important. No, some are important. Some are early, some are promotional, some are underfunded, some have real assets but bad timing. Some may never get built. The phrase national security can open doors, but it does not build a mine by itself. So when looking at tungsten names, focus on four things. First, jurisdiction. U.S. projects may attract attention because supply security is now a real policy issue. Second, grade. Higher grade can improve project economics, but only if metallurgy and scale cooperate. Third, financing. Juniors often drop when they raise money, and sometimes that dip is temporary, but if dilution becomes constant, shareholders pay the bill. Fourth, catalysts. A study, a drill program, an uplisting, or a financing close can change liquidity and perception. There are also companies that were known for silver, rare earths, or gold, but are now highlighting tungsten exposure. That is interesting, but you have to be skeptical. Sometimes the market finally notices hidden value. Sometimes management notices what investors are willing to chase. Those are not the same thing. And that is the broader lesson of this whole market. In a volatile environment, the best stories are not always the loudest stories. Sometimes the best setup is a company quietly advancing while everyone else is panicking. Sometimes the worst setup is a company shouting the right buzzwords while quietly running out of cash. So putting this all together, what happens next? In my opinion, the next move depends on three big gates. First, does the war and energy shock calm down, or does oil stay high enough to keep inflation fears alive? Second, does the Fed lean patient, or does it sound more worried about energy-driven inflation? Third, can junior miners keep advancing without drowning shareholders in dilution? If the war premium fades, oil cools, and the Fed sounds patient, then gold and mining equities could catch a strong relief move. But if oil stays elevated and the Fed sounds trapped, then gold could remain choppy. Producers could face cost pressure, and juniors may need more patience. That is not a prediction of doom. It is a framework. The opportunity here is not in blindly buying everything down. It is in sorting the damage. Some stocks are down because the thesis broke. Some are down because the market broke. Some are down because financing hit at the wrong time. And some are down because investors lost patience right before the next catalyst. Your job is to know which is which. One more practical point. Do not chase every gap down as if it is a gift. In juniors, lower can become much lower when liquidity dries up. Scale in slowly, keep cash available, and decide your invalidation level before emotion takes over. The best investors are not brave every day. They are prepared. They know when a decline is noise and when it is information. That is the difference between averaging down with a plan and simply refusing to admit a mistake. And in a market like this, that difference can save you more money than any stock pick ever makes. That discipline is boring, but boring often keeps you alive. So do the work. Read filings. Compare cash to catalysts. Look at management history. Look at jurisdiction. Look at cost exposure. Look at whether the company has a real path or just a good story. And most importantly, do not let one interview, one press release, one conference, or one social media thread make the decision for you. Use them as clues. Then build your own case. If this helped, subscribe, comment John A.G. Best, and tell me which theme you want next: gold, silver, energy, helium, or tungsten. And just to be clear, this is educational market commentary, not personal financial advice. I'm sharing a way to think through the setup, your portfolio, your timeline, your risk, and your responsibility. Make sure every decision fits your own situation before you put real money behind it.